Good evening, everyone. Welcome to the Loan Officer Training with the Mortgage Calculator. Tonight, we're going to be talking about how to calculate non-QM self-employed income. So we're going to be talking about bank statements here today. So give us just a minute to go live on all the different platforms, and then we will get started. We put the chat up on the screen for now, so you can drop a comment there in the chat as you tune in. You can also drop any questions you have in the chat as we get it started. All right, I see some comments coming in there already. Appreciate it. Good evening, everyone there. Wonderful working Wednesday. Michael, always with the positivity. I love it. All right. So it looks like we're live on all the different platforms, so we'll go ahead and get it started here. All right. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender specializing in non QM loans. And what we do every Tuesday and Wednesday evening at 7 p.m. Eastern is go through a new loan officer training topic. And tonight we're going to be talking about how to calculate self employed income. Tonight we're going to be talking about how to calculate bank statement income. So, our sales manager, Jose, with 28 years of experience, is going to show us how to do that. So, Jose, if you're ready, you can go ahead and take it over.
Good evening, everybody. As some of you could be good afternoon, or if you're in Hawaii, maybe you're just having lunch, right? But thank you for joining us. Today's training really is one that makes me want to smile because I love bank statement loans, right? I mean, there's a reason why bank statement loans are the hottest sector, or the largest sector, should I say, of the non QM loan origination. Uh, the base Definitely a lot of the self-employed borrowers transitioned over from agency full doc to non-QM full doc using bank statements to verify income when the rates doubled, right? Maybe they were approved at 2.5 or 3% for that five, six, $700,000 property, but now it's 6% or 6.5%. They're not going to qualify for the same amount of loan using the same amount of income documentation, but using bank statements as income documentation, we can get that one borrower that maybe is showing a $12,000 a year income net under tax returns after adding back whatever you could add back. And now you could have that same borrower using business bank statements, up to 80% of the business bank statements deposits to qualify as income, and maybe could have $20,000 or $30,000 a month in qualifying income for the loan. That is the beautiful thing about bank statements as income. However, it is non QM, so it is maximum 90% LTV, never any MI. So let me go ahead and share the presentation I have with you today. Today we're going to go over bank statement loans and how to calculate the income. So I will jump right into it. It's real important to know when you're going to calculate the income to know who even qualifies for that type of transaction and what would be eligible transactions, right? I mean, so bank statement loans, for those of you that may not be aware, are for self employed borrowers only with a minimum of 2 years self employment. It says 2 years in business, but you could consider that as 2 years self employment. Now, there is a caveat to that, right? It can be 1 year self employment if they were previously a licensed employee in the same job type. For example, I have their electrician. You worked as a licensed electrician for a company ABC. Now you decided to go on your own. You've been 1 year in business or 1 year self-employed as an electrician, because it could have been as a sole proprietor, right? And you want to apply for the bank statement loan as long as you got those 12 months and you can show that license. Hey, you have 2 years doing that type of job, that type of trade. we can do the deal. But mainly keep in mind we're looking at usually a 2 year look back period, however you're going to combine it. Now, I did touch on it briefly. You got to be self-employed, but that could be a number of things, right? Self-employed doesn't mean you have to be officially incorporated as a C corp or as an S corp, right? Or as an LLC, even, because you could be a sole proprietor. And obviously, that would present a little bit of a challenge, as I touch on in one of the slides, in one of the future slides here. But you can be a sole proprietor, like a sole proprietor handyman, right? You don't have a business license. You don't even have a business bank account. You don't have an LLC. You don't have an S corp. Definitely don't have a C corp. You're just a sole proprietor handyman working, hopefully depositing the money in that checking account, right? Whether it's your personal or your business, probably going to be the personal if you're a sole proprietor handyman. And that's it. Then you'll get your third party verification from the CPA. And that's how we will verify, or CPA, quote unquote, right? We're talking tax preparer, registered tax preparer, we're talking about, or an accountant, or a CPA. Tax preparer is going to have a PTIN number. Accountant should have a PTIN number as well, and the CPA should have a license, some kind of certification, or a PTIN number as well. That's who can provide that third-party verification letter to verify self-employment for your sole proprietor. But I'm jumping ahead of myself. But third-party verification is required for self-employment, right? We just touched base on that. And a lot of different ways to get that. Third-party verification could be from a tax preparer. I mentioned the three we have there. Or it could be from an agency. Maybe you have a CPA license, and we can verify that license. Some type of accountant certification with some special number, and we can verify that from some state or local city or county agency or a federal agency. Maybe you have some type of special business license. Your business has a business license that can be verified that way. So whatever third-party verification you think that you can do as an alternative measure to verify that the person is actually self-employed in some type of a business function. Now, eligible transactions is the usual: purchases, cash out and rate and term refinances, as well as delayed financing. Remember, delayed financing is a transaction that borrower paid cash for the property with their money that they can verify and show where they dispersed the money from their account. And then within a 6-month period from the initial closing of that purchase, they're trying to refinance it to recuperate the outlay of their down payment and their closing costs. That's the maximum loan amount for any delayed financing. Purchase price, the appraised value will be the market value. In some cases, we actually have delayed financing in some of our more extreme outlets that will even include rehab costs in the cost of the property, right? Purchase price, closing cost plus rehab. We have one that does that. I found out today. That's pretty cool for delayed financing. So we covered there who qualifies and eligible transactions. Now, program options, right? Now, this is really key and critical to note. So I have it separated there, the first bullet point. All program options will have guideline variations specific to that option, because in the non-QM world, that's how it works. Every conduit has their own guidelines, because whoever they're selling the loans to, or however they're moving the loans, whatever department of their own, if it goes to another of their own internal purchasing or whatever, secondary, but they're going to have, those are the guidelines. They're really the ones that set the guidelines. Who's buying the loans, because the loans get put into a package, get sold out there in the secondary world. So we have first mortgage and second mortgage options for bank statement loans, right? We have some good fixed rate second mortgages and actually just released some HELOC options for bank statement loans. So that's all pretty cool. Max LTV for purchases, 90% owner occupied, 85% investment. refis, cash outs is usually 85% primary max LTV and 80% investment max LTV. Max DTI usually 50%, but some options go as high as 55% on the DTI. Now, we start breaking it down here a little bit so you know how to analyze. You have to know how to analyze what you're looking at so that then you can fill out the form properly to calculate the income. Because in the end, it just goes on an Excel spreadsheet. But in order to pick the right data, you got to know what you're looking at. So business bank statements, if that's the option, that's what they're going to be provided. The default usually is 50% expense factor, but we have options as high as 80% expense. 80% profit, 20% expense factor. So it would be as low as 20% expense factor, 80% profit margin default. And I'll show you that table in a minute. Typically, you, depending on the option, if the option you're choosing has a 50% default expense factor, then you can increase the profit margin, decrease the expense factor with a CPA letter, right? Stating what the business expense factor is. Personal bank statements, you can use 100% of business deposits, and in some cases, they're going to ask you to provide. So this is where you got to read the guidelines well, because in most cases, they're going to ask you to provide anywhere from 2 to 3 months of business bank statements to document that the deposits going into the personal bank statements are actually business deposits, right? Because it'll be like a transfer usually. And in some cases, if the borrower does not have a separate business bank account, they will treat the personal bank statements with the same guidelines as if they were a business bank statement, and then may apply an expense factor from 20 to 50%, depending on the option that you select for the loan. So keep that in mind. Personal bank statements does not always guarantee it's 100% usage, because of you need usually to have a separate business bank account. So now you can combine business and personal bank statements. They call that commingling in the industry. However, note that when you commingle business and personal bank statements, then the expense factor applied to the deposits will usually be what the same expense factor that you're applying to the business. So if it's an 80% expense factor to the business, it's going to be 80% expense factor to the personal bank statements, and 70% it'll be 70%. So just keep that in mind when you're doing your analysis. Now, very important to watch for NSS and overdrafts. Usually more than 3 and 12 months is not going to be acceptable by most guidelines. Now, we do have an option that does not consider NSFs and overdrafts as long as they're explained away. Now, that's, we may have more than one option, but I know one option in particular where they state it doesn't matter, but then it does state there has to be a reasonable explanation for the overdraft, and then preferably the overdraft was covered by some kind of overdraft protection or covered right away. Because if that overdraft lingers till next month or for a week or two, that's not going to look good, and then the underwriter may condition you for additional documentation or some other negative fact to your loan because of the NSS and overdrafts, right? Because that's a red flag. That's a red flag. You're saying a business has an 80% profit margin, 20% expense factor, but the business is continually doing overdrafts and NSS, and then maybe even ending with low ending balances at the end of the month. Where's the money going to? They're definitely going to ask you for more documentation to see, are you just taking all this money out to your personal, or does the business just have a whole lot more expenses than we are led to believe? Because that's another thing. They're going to look at the expenses that you can see clearly on the bank statement, right? It's not just credits that are on the bank statements, it's debits as well. They're going to see all those debits, and if they see a lot of business-related debits, and it's not like debit because you're taking the money out, you may have an adjustment to your expense factor, or you may be asked to provide, the borrower to provide a profit and loss report now to document that low expense factor. Now, simply a letter may not suffice if all of a sudden you have bank statements that show to the contrary, right? Because remember, the bank statement lists all the deposits, but it also lists all the debits. And those debits are usually, detailed as to what they are. So real important. Take all of that into consideration when you're even structuring the deal, because at some point you may need to pivot from a bank statement loan to a profit and loss loan. Some profit and losses don't require bank statements. Most do require the last 2 or 3 months, but not all do. But you're gonna, if it's a rate and term, you got to show 2 months bank statements for reserves, and if it's a purchase, you got to show the 2 months bank statements for reserves as well. So the last 2 months activity may be there if they're using the business bank statements for assets. So, what are some of the potential issues? I already touched on most of these, but some of the potential issues you face when analyzing the bank statements and analyzing the whole scenario to see what you're actually going to put on the form to actually get the income is that the borrower cannot document the needed business history, right? You have the self employed borrower, sole proprietor, no operating agreement, or maybe the operating agreement in the articles was from when they formed the LLC only a year and 2 months ago, and before that they were a sole proprietor. They're in a business that doesn't require a business license. What do you do, right? Oh, and on top of that, they self file, so you don't have a CPA to provide the third party verification letter. So that's a challenge. You really got to dig deep there, try to figure out ways to get creative. Look at the guidelines, see what you can do. But that's a tough one. So they self file at this point. They may have to establish a tax preparer slash accountant slash CPA relationship and have them look at their tax returns and be able to provide the letter that you need for third party verification of self employment, because that's really the best way to do this. When you're in that scenario, the best and most secure way is with the third party verification letter from the professional, right? That's if not, it may be tough. I had one where he owned like a convenience store, self filed, and didn't have the docs for the 2 years on the operating agreement, all that kind of stuff. So we were able to get a letter from the franchise company. I think it was like 7-Eleven, and they actually wrote a letter on how long he'd been a franchise owner and all that kind of stuff and operating the business on their letterhead. And that worked. But it was a letter, nevertheless, right? Another potential issue that you're facing here: declining deposit trends. That one is readily visible in the statements. Definitely, the profit and loss report is the solution for declining deposit trends. Large deposits that cannot be documented. You all heard the story of the P&L loan that I helped one of our MLOs on, her first loan. That's what that borrower had. We reviewed the 12 months bank statements, and he had like deposits only in like 3 months or 4 months. He was depositing like $250,000, $300,000 like 4 times a year. And when we asked him, okay, can you get us some contracts and stuff like that, invoicing and stuff to document these deposits, he said, that's going to be tough. So, but then we asked him, do you have an accountant that could provide a profit and loss statement to document your income? He said, I sure do. And we closed that one in 3 weeks as a profit and loss loan, 85% LTV. That's how you deal with large deposits that cannot be documented. Because keep in mind that pretty much all guidelines, I don't know of one non-QM guideline that does not require verification of any deposit that's at least 50% of the monthly income, right? Whatever you calculate the monthly income, if it's $30,000 a month, then any deposit of $15,000 or more has to be documented by like copy the check to see that it was actually paid by somebody, right, as business income, or a copy of a contract to show what it was, whatever you can provide to document that it was business related income. And again, the P&L program can resolve that. Irregular deposit trends, that's similar to the situation I was talking about. Again, profit and loss loan option can resolve that. NSS and overdrafts, we discussed that. Either find the option that we have that doesn't have an issue with that, as long as they can be explained, or if the other guidelines of that conduit doesn't work for the other parameters of your loan, then P&L loan will resolve that, and just hope that the NSFs and overdrafts were not in the last 2 months. Another issue you can have, I touched on it already, the underwriter reviews the bank statements or reviews the business type. You have a high overhead type business with 7 employees, they're going to adjust your expense ratio and increase it. And at that point, it could result in a request for a P&L due to it's a guideline requirement, or due to the irregular deposits, high expenses, or any other issues that could result in additional documentation requested on your loan. Could kill the deal, right? That's why it's so important. You review the guidelines, look at your loan parameters, and make sure that you're okay. Now, calculating the income. What was I talking about right now? Review the specific guidelines for the loan option being selected, as all non-QM guidelines are unique to each investor. You're going to use the Excel spreadsheet required by the investor for the option chosen. I will be showing you that spreadsheet in a minute. Again, beware of NSFs, ODs, how that, and ending balances. When you're filling out that form, you're going to input the total of the deposits on the first column, and then to each succeeding column to the right, you're going to input non-business related deposits that are going to get backed out, right? So whatever, minus 800, minus 600, minus $38.23. All of those are going to get backed out from the gross deposit, so that you have a net deposits for that month, which appears at the end of the spreadsheet. And I'll show you that in a minute. Main thing to note, deposits that you're going to back out, transfers from other accounts that are not business income, just a transfer. Credits like a return item credit or any credits like that that are not business income. Unverifiable large deposits that we were talking about. Or unverifiable deposits if they end up asking you to verify them, but it's usually going to be unverifiable. Large deposits are going to be any deposit of 50% of the monthly income or more. So again, be aware of the expense factor ratio restrictions. I'm going to show you that chart in a minute. You make sure you compensate when you're doing your calculations, compensate for the proportionate share of business ownership. So besides the profit margin, right? So let's say they're at an 80% profit margin because they have a 20% expense factor. But then you also got to calculate, are they 100% owner of the business, or are they 50% owner, 60 or whatever percentage? In most cases, 25% is the minimum ownership percentage that you can have to be able to use business bank statements or bank statements in general to qualify. So whenever possible, our investors and some of the lenders for the wholesale option have a service that you send them, upload to a secure link, the bank statements, and fill out a form, and they will calculate the income for you. What they will consider. You may want to double check their calculations. They're not infallible. It's just a human being doing that service for you, and also confirm with the investor regarding the income guarantee. In other words, will underwriting use that income? Is it guaranteed that's the income, or is underwriting going to come back, review it, and say, hey, okay, yeah, that was good. That's a service we provide, but this is the real income that I reviewed. So you want to make sure you don't get caught off guard by that. So before I share the spreadsheet, again, really important, I just wanted to share with you a sample guidelines and the fixed expense ratio grid I was talking about. This is a guideline, an excerpt from one of our conduits, just so you can have an idea of some of the things that they say, right? This was for a business bank statement qualification option, and notice what they're telling us. Must be consistent. The deposits from the most recent bank statement must be consistent with the qualifying income. Remember, we're talking about declining trends. If it's 24 months we provide, they only take the income from 12 months. Total deposits minus any inconsistent deposits, multiplied by profit margin by ownership percentage divided by the number of statements reviewed. That's right. We covered all of that. Then some examples of unacceptable deposits or excluded. Stuff like cash advances from credit cards, income sources already considered, like lease payments, rental income, right? If you're already getting 75% of that as a different stream, you cannot also count it as a bank deposit stream. Non-business related account transfers, tax refunds, product returns, credit gift funds, credit line deposits, business financing, SBA loans, stuff like that. Those aren't deposits. Now that would be considered income. Now I mentioned fixed expense ratio. This is actually an excerpt from one of the guidelines from one of our investors, where they're telling us right then and there, right? If you use that option, which happens to be the same guidelines for the one I show you here, if you use that conduit for the loan, then if it's 0 employees in the business, if it's a one-man shop, service-related business, right, you're going to have an 80% profit margin, only a 20% expense factor. Now, if it's a product-related business, I know you have more overhead, right? Then you have 40% expense factor, 6% profit margin. Now, if you have 1 to 5 employees, again, you can do the math. Service-related business, 40, product business, 60. That would be like the convenience store. And then 5 plus employees. So this is just one example of the default table. And then if you felt that your borrower's expense factor was different than this, and you definitely wanted to use this conduit rather than another one that may not have this fixed table, then instead of the 50%, then you would have to provide a letter from the quote unquote CPA. Now, I just closed one with this conduit. It was great. It was a no employee service business, short-term rental business. He had 6 properties, rented all himself. And it was an 80% profit margin on the deal. So why is all that so important? Okay, because when you come to the sample worksheet, right, you got to look at how it's set up. So I mentioned to you, I hope you guys can see the numbers, but this first column, well, actually, the second column, this is just 1 through 12. This second column here is showing the dates of the month for the bank statement. So this is August, July, so forth and so on. This was the total deposits. And then over here is where I would put any amounts that you feel for whatever reason after review are non-business related deposits. So you put it with a minus, adds them all up here, and then down over here on the right-hand side, you get the net figure after the non-business related deposits are deducted from the gross. And then each month that happens, it all adds up here to the total deposits. And then that figure gets added up here. And then here you have our 3 options, right? Our profit and loss expense ratio validation, our default guidelines expense ratio validation, in this case it's 50%, and our CPA letter expense ratio validation, depending which one we're using. So if we go here with the 50% default ratio, right, our income 12-month average is 7292.97. If we go with the CPA letter, for example, and the CPA letter says the expense ratio is 35%, meaning we're going to get more income, right? Because we got 65% profit. So now our income is $9,480.85. Our income went up because now we're 65%. Now, if I was using that other option at 80% and it was a service-related business, then this would be set up at 80% or 20%, I guess, if you're talking about expenses ratio. And then my income would be here much higher. So that's just depending on this worksheet you could use for any of the different conduits. You're just going to set it up differently here. But keep in mind that most conduits may have their own worksheet. So once you figure out where you are going to send the loan, then you would obtain that worksheet. So that's all there is to it, folks. Notice that there's a lot more setup to this process by reviewing the structure of the loan, seeing the guidelines, seeing which is the guidelines that works best for the deal. And then the last thing that you do is you do the income calculations here, because now are you going to use 80% or are you going to use 50%, right? Or should I say 20% expense, or are you going to use 50% expense? That's what it all goes down to.
All right. Looks like we got some questions here. If you want to pop them up on the screen there. First question is, if a self-employed borrower is also using a W-2 to qualify for higher loan amount to purchase a property under their business, is the self-employed borrower's credit taken into consideration? So basically,
Uh,
if they're going to close in a LLC, I guess they're trying to say if the borrower's credit considered.
well, I'm not sure if I understand the question, Eileen. Maybe you could expand a little because basically what I can tell you is you are through a couple different conduits that we have. Now, not every guideline allows this, right? But some guidelines do allow you to mix W 2 income, to commingle W 2 income with self employed borrower income, right? And the fact that let's say if this is an investment loan and you're closing in an LLC, doesn't really matter if you're using W 2 income and bank statement income. It doesn't really matter. Only where that would come into play is if you're doing the loan as a DSCR loan, where you're not using any personal borrow income, and then it's a true business purpose loan. Other than that, you just have a borrower closing an investment property that is using one of the tools that we have, which is combining W 2 income with self employed bank statement income, just like you can also combine it with asset utilization, like we discussed the other day, to increase the income and qualify for the loan.
All right. So what if the borrower can't prove the source of funds in the bank statements?
All right. Yep. We discussed that. So if the source of funds really would, I guess it would be more like, what if the borrower cannot verify that the deposits were business related? Because they're not really looking for source of funds if we're talking about income qualification. Now, source of funds would be if we're looking at asset verification to verify seasoning of the funds for the down payment, closing costs, if it happens to be, if the guidelines actually require that. But if we're talking about unverifiable deposit that you can't verify it as business related income, then that deposit would be backed out of the income calculation, right? That's why I was mentioning that a workaround for that, if now all of a sudden your borrower doesn't qualify even at an 80% profit margin, would be the profit and loss loan option. And also remember one other thing: there's many times you may have borrowers qualifying under bank statement option that actually receive a 1099. Right, a 1099 actually has a 90% profit margin. So always ask your borrowers if they happen to get a 1099, because that's a different loan structure, and it could be easier to resolve because then it's just a 1099 form, 10% off of that, that's the income.
All right. And I think that is it for the question. So thank you everybody for tuning in. This is definitely a core one that we need to know, right? So always good to go over it. So thank you, Jose. Thank you everybody for tuning in. Remember, we do this at 7 p.m. Eastern time every Tuesday and Wednesday evening, where we go through a new loan officer training topic. So we will be back next week, Tuesday, 7 p.m. Eastern, for the next episode of the loan officer training series with the mortgage calculator. Have a great night, everyone.
Thank you, everybody.